Hello, everyone. Welcome to today's ADIT webinar, our latest international tax webinar. And yeah, wherever you are in the world, good morning, good evening, good afternoon. We hope you enjoy today's session. We're going to be looking at the UK double residency provisions for individual and corporate taxpayers today. Dual residence can be a complex topic to navigate for any person or company based in multiple countries. And the UK's double residency rules are certainly extensive, both for corporate and individual taxpayers, with a whole host of issues to consider. Our expert speakers, Luda Beanland and Dmitry Zapol, will today offer their insights on the current regime and how it applies. Luda is a chartered management accountant and a chartered tax advisor with us here in the UK. Luda has a wealth of experience advising on owner-managed business, corporate and international taxation, including international issues for both. She has founded and manages a number of companies based in the UK and Dubai. Having worked for a number of years in both the corporate and charity sectors, Luda currently specialises in taxation, as well as management accounting and cash flow management. Luda holds our ADIT qualification and is an international tax affiliate. Dmitry Zapol is an international tax and business advisor with practical knowledge of the principles of individual and corporate taxation and cross-border business planning. Dmitry routinely advises high net worth individual clients in connection with their international relocation and advises on the use of international holding structures. Dmitry is the owner of IFS Consultants, an international tax practice, and is an ADIT holder as well, and also an international tax affiliate with us. If you have any questions during the webinar, either for Luda or Dmitry, on either the individual or corporate side of things, please don't hesitate to type in your question using the Q&A box. We'll do a Q&A session at the end of the webinar, so any questions you ask we'll be able to pose to Luda and Dmitry. So without further ado, I'm going to hand over to Dmitry to do a bit of a more detailed summary of the topics.
Thank you very much, Rory. Good afternoon, everyone. Luda and I have worked with numerous clients who are coming to the UK and who are leaving the UK. And the purpose of today's webinar is to share our practical knowledge and experience in this field. There are many reasons why anyone would consider coming to the UK or bringing a company. First of all, nowadays, there's a very favorable immigration regime. We're not talking about it, of course, but we know that it's much easier to come to the UK than in many other countries. Also, the UK has certain peculiarities of taxation of individuals, which allows them essentially to rely on their foreign status or their foreign domicile status to plan their taxes effectively. And of course, the UK has a wealth of various exemptions for companies, such as participation exemption in respect of dividends and capital gains, absence of withholding tax on dividends, etc., which allows it to host holding companies, trading companies, etc. So there are many reasons why companies and individuals would choose to come here. Equally, there is a reason why a few may choose to leave the UK. Some individuals may near the end of their non-domicile period, which is 15 years, and then they don't want to pay any tax in the UK. Also, there are reasons why companies may want to leave the UK, also known as to re-domicile abroad. So Luda will start talking mostly about personal issues arising on coming to the UK and leaving the UK, and I will finish up with the corporate issues. And in the end, you will all have a chance to ask us questions. Thank you. Please, Luda, go ahead.
Thank you very much. Let me just share my screen. Just give me a sec. Yeah, that's it. Right. First of all, thank you very much for joining us today. Today, I would like to touch up on the UK double residency provisions for an individual. Things I would like to talk about for someone who arrives in the UK and someone who leaves the UK, and anti-avoidance issues related to those ones who decide to temporarily leave the UK, as well as managing residency risk and practical points from my personal experience dealing with expats. First of all, why residency status is important, why we even bother about it. Depending on where your residency is, that's where you are liable for the tax. Therefore, it's quite important actually to understand in which country you are a resident. As an example, in the UK, if you're a UK tax resident, you're potentially liable to pay tax on worldwide income, whereas if you're non-resident, you only will be paying tax on the UK income such as pensions, limitation on dividend and interest, salary if you earned it while you were a UK resident, share options, and other awards. Generally, when we talk about domestic legislation here in the UK, that's where we are based, we are talking about 3 tests. One is automatic overseas test, second one automatic UK test, and third one is sufficient ties. Effectively, it's a set of rules, and you've got to go from a very start. Lots of advisors, when somebody starts their career as a tax advisor, I can see they just jump straight away test in the middle. However, we have to go from a very start, and once you are caught under certain provision, you just got to stop there. Okay, so first one, let's have a look at automatic overseas test. First of all, that's pretty much simple. It's if you arrive in the UK and you've never been, or you haven't been a tax resident in the last few years, last year, you can come here for 16 days and you automatically would not be tax resident. That's basically for someone who is a visitor on a tourist visa, I guess, would come, or on a conference, you know, for a few days in the UK, they're not tax residents. However, if you have been in the last previous years UK tax residents, you're looking at maximum 46 days. Okay, so if you spend less than 36 days, you're not UK tax resident, and meet other conditions such as you've got full-time job in outside of the UK, that's average 35 hours. And by the way, work day in the UK if you work for 3 hours or more, which is nice. Okay, and you haven't got any significant break. Significant break is 30 days in a row, pretty much. And also you are in the UK no more than 91 days. Then we look at automatic tests, which majority, I think the majority of tax consultants would know the middle one in the middle, 183 days. But as I said, we would really need to start from the very top. So automatic UK test, what's that about? If you meet any of these tests, you're automatically UK tax resident. You spend more than 183 days, you're having home for part or some of the tax year, and you spend in accommodation more than 30 days. Now that's very interesting one, and there is a lot of debates with the HMRC among the taxpayers what exactly home is. So a point of discussion is not discuss the home, but that's the rule, and it's subject to interpretation. Next one, if someone came actually to work in the UK. I meet quite a lot of people. Listen, Luda, I came, you know, last year to work full time. Actually, am I UK? Well, most likely, yes. You know, if you came in the UK without significant breaks, you work full time, that's pretty much, you are UK tax resident. There are some rules, but generally speaking, you are someone, I mean, a taxpayer would be UK tax resident. And now, when we've done first couple of tests, we are coming to the third one called sufficient ties test. What's that about? That's about, there are certain ties to the country, and there are tables depend on how many, the number of days you've stayed in the UK in a tax year. What is a tax year? We've got very interesting tax years starting from 6th April to 5th April. That's not like in the majority of countries from 1st January to 31st December. That's again from 6th April to 5th April. That's our tax year here in the UK. So let's have a look at ties, and then we'll have a look at tables. So family tie, if you've got a family member, say wife or a child who are here with you, your child, we mean someone who is under 18 years old. That's pretty much you've got the family tie. Having said that, there are quite a few exemptions there. If, for example, you've got your wife or your husband, they have the same circumstances you have, they're not actually family tie. Also, if you have a minor child, under 18 and they go to boarding school and there are certain rules, so many days they have to stay, they also can be not your family tie. So when we have a look at family tie, there are lots of, quite a few exemptions there as well, just to make it more confusing. The next one is accommodation tie. That's pretty much available for you to live for continuous period of 91 days. So if you've got a brother or sister or someone else, where there is a room available for you at all the time, that's your accommodation tie. Work tie, if you work in the UK at least 40 days, that in the tax year. Remember, tax work day is 3 hours. If you work for 3 or more hours a day. 90-day tie one. That's if in the last year or in the year before you spent in the UK 90 days or more. And the very last one, if you stayed in the UK, at the end of the day, more days than in any other country. That's where you travel quite a lot. So that's sufficient ties. Now, you count how many ties you have got, and then you have to apply them to the tables. Here's the tables. We are not going through the tables, from these tables, otherwise we'll fall asleep. So this table is for someone who is a leaver in the UK. You apply a number of tests, and the other one is arriver. If you fall into that, you are UK tax, your UK tax resident, okay? Now, it's very important. So we have a look at someone, we decide, okay, actually you fall under one of these tests, and in the tax year, say 23-24, you're a UK tax resident. What's next? Now we need to understand exactly when they have become tax resident. Generally, we have what it's called split year rules. So what they are about? They're about some individuals would like to start being tax resident as late as possible, generally speaking. And it's not, actually, these apply automatically, having said that. Either someone wants or not, these apply, split year rules apply automatically. But the beauty about them, you do not become tax resident from the 6th April, you start from the day these tests apply. So cases 1 to 3, it's full-time, you are living. That's for someone who is living in the UK. You have full-time, your partner, someone who works abroad, or you cease to have a home in the UK. Someone who arrives, cases 4 to 8, you've got the only day, the only home in the UK, you're starting full-time job, your partner, someone, season full-time abroad, and you just haven't a home in the UK. So practically speaking, quite a few of our clients, for example, they come in the UK, they are staying in a hotel or B&B somewhere, and then in a month's time, they find accommodation, they move in. That's pretty much when they probably, or that split year would, they acquire the home to live, depending if it is case 4 or 8, depending whether they have other homes and so on and so forth. So that's why is it important for us to understand when exactly, why we even bother? Because depending on what they did before they became tax resident, have they taken tax advice? Have they arranged their clean capital? Maybe immigration rules, maybe they could become resident. When we look at immigration also rules, maybe they should have started, it's for them, they really should be tax resident from later day to comply with the immigration status. So these are rules, they apply automatically. It's not we choose, or it's something we can elect or choose. So these were domestic rules. Now let's have a look. We have quite a few clients who come along and say, actually, Luda, you know what? I come from Dubai, say from Emirates, and I live there. I am actually, or in Cyprus, we've got quite a few clients coming from Cyprus and listen, actually, I am a tax resident over there as well. And under local rules, we are tax residents there as well. So in this case, we would have a look whether we would leave domestic rules, and we would go and we would look what OECD treaty says, and in particular Article 4. I use interpretation OECD and interpretation King van Raad, an interpretation of these rules, which we are going to go through. So they go also in hierarchy. like we have UK domestic ones, we look at permanent home, center of vital interest, habitable adopt, nationality, and at the end, if everything else fails, then there is a map, Article 25 in OECD. So let's have a look. Permanent home. What is exactly permanent home? When I look at King's and Rath, permanent home is described as something there is a degree of permanence. Okay, that's not something in a short. It's the precise wording is something old or possess, as opposed to short duration. And then we would have a look at the other, what actually home is. Home, we take ordinary definition of actually what home is. That is a dwelling available to us at all the time. It could be apartment house, it could be even a room, but there must be some degree of permanence there. Right, so if, say, our client have, say, Luda, actually, you know what, I've got a home in Cyprus, or I've got home in Dubai, and I travel between two countries, it doesn't really apply to me, you know, it's quite difficult, or it's quite difficult to determine which exactly my permanent home. Then we move down to the next one, center of vital interest. Then we have a look, okay, do you have a family? What about your social relations? Do you have subscriptions anywhere? Do you have your, where do you conduct your business from? What about your political? You know, where do you normally vote? Do you actually vote? So cultural, so we would have a look at center of vital interest. And from my practical experience, clients I have had, that's pretty much where we normally would stop. And I can't think of anyone which would go beyond. However, there are rules beyond, we have a look. Because that's pretty, I think, where your family normally is, that's pretty much easy. You know, where you conduct the business from. When you look at it, there would be some attachment to one place than the other one. However, having said that, there are obviously individuals who equally, they have family on both sides. They can elect, say they've got dual nationalities, they can vote in both, they've got political. So I'm sure that there are plenty of people who would say, well, actually, it's quite difficult for me to determine where my center of vital interests are. So in this case, we will have a look at habitable adopt. Now, very famous chat GPT. Just out of interest, as we know, ChatGPT, it's, you know, some information actually it's excellent. Some of it is like, I'm not quite sure. So, well, let me just have a look whether GPT chat, just out of interest, would get it right. And I highlighted it in bold. Actually, in this instant, I would say that's pretty much about right. I think the majority of you hopefully agree with me. That's determination. That's where, oops, let me just move a tiny bit my window. So we will have a look where physical presence is, intention to make the place of someone's home, duration of their stay in one country or the other one, and other circumstances in a particularly related and have connection to a particular location. So I think that's pretty much about right. However, we have a look, obviously, that GPT, we can't really, you know, client comes and say, well, GPT says, you know, that's, well, just a bit of fun to have a look. But however, we look at OECD actually here, and OECD, interesting, and they have interpretation says that where there are two cases. Case A, where individual has two homes in the contracting state, and second one has neither. Okay, what's that about? So if somebody has got two homes, then we interpretations suggest you have a look where a taxpayer stays more regular in one place or the other one. Okay, so that duration of stay, frequency of stay. And the case B considers actually there could be a case where someone doesn't have home and they just travel from hotel to hotel. How would you determine here? You would have a look where you still have probably, well, most likely more frequent stay in one country than the other one. However, if that fails, and it's still quite difficult for the client to say, listen, I've got, I either haven't got home and any home, I stay in the hotels and I travel equally between a few or two countries, and or case A, where an individual's got two home and stay identically the same frequency and regularity, then we would have a look at the next one, their nationality. And it's very often, we already get to that point where people actually, our clients, taxpayers have a dual nationality, okay? And then, however, if it is one, that would really help. You can say, okay, you've got, we go to that point, you've got one passport, you're Cypriot, that's fine, you're resident there. However, if someone is dual nationality, that would be, again, quite difficult. Then eventually, if everything else fails, we will have a look at MAP, Article 25. There are special provisions. We are not going to deep into the, Article 25 because that's not the point of today's webinar. However, there are certain procedures which taxpayers can go through. Practically speaking, from my practice, in the UK, if somebody comes along, then normally would be, you're looking at someone who stays in the UK less than 183 days. That would be, and the state in the other country, they would stay more than half a year. So that would be typical, in my opinion, taxpayer. And say, Luda, listen, I'm also in Cyprus, I'm a tax resident. We'll say, okay, what we need the residency certification from Cyprus. If you could give it to us, then obviously we'll go through the hierarchy of the rules. Normally, with a center of interest, say we said, yeah, you're not resident here. If we use Article 4 in this instance, we would have to complete a tax return here in the UK. We would have to attach tax residence and complete special pages. That's normally goes as an attachment form SH302. Okay, so we have to attach it and send it to HMRC. And pray that HMRC wouldn't come back. We say always to our clients, there is a certain risk attached. That's how you feel that your center of your personal interest elsewhere than the UK. However, HMRC might have their own opinion in this respect. So there is always, we warn our clients, there is always risk attached to that. However, let's move on to someone who lives now in the UK. When you lived in the UK for, say, 15 years and you're deemed domicile, like probably would be myself now, you're deemed domicile in the UK and you really don't want to pay tax. Some people say, well, why don't I get out from the UK and then come back, with that permanent temporary residency less than 5 years, I will do some sales, I will declare dividends and come back, would be nice. They can do that, but they have to wait 5 years. That's what it is about. We call them, what is temporary non-residency? That's someone who stayed 4 years out of 7 prior the year of departure. That's probably the last rule here, should be probably the first one. You're looking at someone, because if you came in the UK 1 year and you left, you stay for a couple of years, you leave UK, you're not actually caught on the non-residency rule. That's only for someone if you've been 4 out of 7 in the UK. So on your return, you are UK tax residents, because there could be a number of days, you still can come pretty much, generally speaking, up to 19 days, but case by case is different, okay, just a bit of warning. You still can come in the UK and you wouldn't be tax resident, so that wouldn't apply to you. However, so you should be tax resident, and you can back within a window of 5 years. You will be caught up. Okay, these are what is exactly non-temporary, who temporary resident is. So as I said, there are anti-avoidance provisions to stop taxpayers to getting out of from the country. And so if someone comes back within 5 years, HMRC would tax in full whatever happened in that. Well, generally speaking, that's dividend declared in that tax year, that's capital gain tax, anything else that if you were a tax resident within this period of time of your absence in the UK, you would end up paying tax on your once you resume your residency. That's pretty much the rules. There are a couple of examples here. I'm not going to read in detail, but one is related to someone who lived in the UK all life. Citizen lived in the UK for many years. Now she decides to live in the UK, leave UK, and she declares dividends in the UK. They obviously would have been taxed if she were a UK tax resident. However, she got out of the country, she was not UK tax resident, and she came back within 5 years. So what happens here? Anna, the now example, her name is Anna. Anna would be liable on the dividend tax because she came back, she was caught under avoidance rules, she would end up paying dividend tax on her return. However, if Anna would had stayed 5 years away from the UK, then she wouldn't have been liable. The other example is Mr. Swift, who lived in the UK all his life. He lives in the UK and he sets an asset. Okay, and he realizes chargeable gain. That gain, if he comes back within 5 years, that means he would be liable on capital gain tax. And that asset Mr. Smith purchased while he was a resident before. Okay, that's quite important. Right, so now for practical issues and managing residency risk, what exactly practically we can actually get out from that? First of all, when somebody arrives in the UK, we look at domestic legislation, a UK tax resident. Say if they were less than half a year, that generally sort of less riskier, I would say, and they claim their resident elsewhere, they bring tax certificate, and they wouldn't be tax resident. However, having said that, we came across quite a few clients who actually, by immigration, they really got to be tax residents here. So practical issue, when you have a client, they come along, have a look what their visa is. I normally ask, oh, immigration, I'm telling them, taxation or immigration, residency, two different things, don't mix and match. Having said that, if on their visa, they're supposed to be tax resident, and in 3 years or 5 years time, when they apply for permanent residency here in the UK, that wouldn't be advantageous, and they wouldn't be able to receive passport or permanent status. Actually, we would advise them first, speak to your immigration advisor whether it is beneficial for you claiming treaty, applying Article 4, or you would be better off being UK tax resident because actually under domestic legislation, you are tax resident. So I would normally ask them, take an immigration advice. One of companies I manage called UK Endorsing Services, we actually deal with a lot of expats, someone who comes in the UK, and we assess the business plan for viability, scalability. And if we are happy, we give them the letter, and they apply with that letter with the Home Office. So we provide public service as well. So for them, actually, they really got to be tax residents in order to apply. Then after 3 years for BRP, for indefinite leave to remain. So here, quite a lot of consideration. Practically speaking, we would look at immigration and ask our clients to take immigration advice. If we are claiming if we are claiming Article 4 on their tax return. We advise our clients keep diary with dates when they're staying abroad. So just because our human memory is not very long one, so we ask our clients to keep journals and diaries. Organizing clean capital before someone arrives in the UK, we tell them, listen, what's clean capital? Money on before residency, gifts, and money received from inheritance. The most misunderstood, I think, concept of clean capital. Clients arrange that clean capital, they become tax residents, and then they use that cash pot to buy something else. I was like, why have you done it? I was like, I thought. So I was like, no. Once you have cash, you keep it in cash. You don't touch it, So make sure that the clients do understand what the concept of clean capital before arrival. That's practically, application split year treatment. Don't forget about them. When we advise someone, make sure that because they apply automatically. It's not like I don't particularly want to use one, so they apply automatically. Using foreign domiciliary, Dmitry mentioned at the very start that there is a very generous way of taxation called in the UK remittance basis. That's for someone who coming in the UK by redomicile of origin. Someone was born abroad and they are actually thinking they're going to come back at any point. They are foreign domicile. So use that to claim remittance basis. You only would be paying tax on your UK sources, provided you don't bring your earnings you earned while you were UK tax resident here in UK. You don't use that earnings here, okay? And you've got clean capital arranged. So the next one, if you've got employer who sends you work in the UK, remember your employer can pay up to £8,000 to pay for your relocation costs here in the UK. That's also tax-free. And the last one, if someone arriving in the UK and the assignment for less than 24 months, they can claim detached duty relief. What it means, they wouldn't be paying any tax and would be as benefit in kind, we call it, if employer provides accommodation and food to them. So that's pretty much it. I hope you found it useful. And if you obviously have any questions, do get in touch with me. We'll be happy to hear from you. Otherwise, I'll pass you to Dmitry, who is going to touch up on a company taxation. Thank you very much. Dmitry, over to you.
Luda, thank you very much. I will try to do the magic and share my screen with you, so please bear with me. Okay, here we go. Can you see my screen? I'm so sorry.
Not yet, Dmitry, not yet.
Do it. Here we go.
Right. Yeah, that's all good. Yeah, yeah, we can see that. Thank you.
So this is the bit about me. Luda, thank you for covering the personal tax issues. I thought I would talk to you about the corporate redomiciliation issues, which I think are quite relevant. Now, it's best if I share with you a little story, a story of my client, which is a large manufacturing company, which has manufacturing facilities all over the world, and they're conducting sales through their UK headquarters. They came to us recently and said, listen, now we know that from April, instead of 19% corporation tax, we have to pay 25% corporation tax on our worldwide profits. What can we do? Is there any way that we can reduce our tax burden? And I said that the only way would be for you either to move operations from the UK or to re-domicile your company. First, I asked, is it possible for you to just cease your operations in the UK and just sign your contracts elsewhere in a different country? They explained that this would be quite hard because they have long-standing business relationships with other business partners. Also, if they moved the operations, it would be called what is a cessation of trade, which would result in tax consequences. So we decided to talk about corporate re-domiciliation, also known for corporate immigration or migration. Now, before Brexit, there was a possibility to use the EU merger directive. This would result in a UK company merging into an overseas company and then seizing its presence in the UK, therefore with all the contracts, with all the assets passing overseas to the new entity abroad and terminating its tax presence. Alternatively, a UK company, while we were in the European Union, could convert itself into a European company, also known as a Société Européenne, and literally take off from the UK company's house and move elsewhere to another corporate register. Now, of course, that we're no longer members of the European Union, such options are unavailable. It is possible to do a share-for-share exchange where the UK company would become a subsidiary of a foreign holding company, but this is not the case in our situation. So we, in that, decided to consider the option of changing the place of effective management and control of the company. What does this entail? Essentially, it means that we are removing the UK board of directors. We are appointing a foreign board of directors in the country where they want to move. We're moving all the corporate documentation from the UK to the new destination. And as if by magic, the company stops being UK resident and moves abroad. Let's discuss what happens in this situation. Under UK law, we are talking about the place of central management and control. Essentially, this is the place of the highest level of management where the decisions of the directors are taking place. Whereas under UK's double tax treaties with popular tax havens such as Cyprus, Malta, Netherlands, Switzerland, we're talking about the place of effective management and control, which means essentially the place where day-to-day operating decisions of the company are taking place. In reality, when we're choosing to move a company from the UK abroad, we want to make sure that both its strategic decisions and its day-to-day decisions are taken overseas. We have to, of course, follow the procedure established by law, and we have to notify the HM Revenue and Customs of our decision to terminate UK residency of the company. This is normally done in the corporation return, in the corporation tax return. What happens when the company ceases to be UK resident? It ceases to have its trade in the UK. It ends its accounting period for UK corporation tax purposes, but most importantly, it is considered to have disposed of its assets and reacquired them instantaneously. In essence, this means that the company may face a huge corporation tax charge in respect of its assets. Therefore, it's very important to make sure that we value the assets carefully. When a business is leaving the UK, there are broadly two sorts of assets that we can consider. There's the actual business and there's goodwill. Business, well, we are following the usual valuation practice. We're looking at turnover, we're looking at contracts, etc. And by law, there is no specific rules applying to who is doing the valuation. In principle, a company can use its accountants to do its valuation, although of course it's popular to retain it overseas or a professional valuation firm, which will provide the report. And normally, if you're following a reasonable method of valuation, the UK tax authorities will be happy. However, we have also goodwill that we have to value. And typically, this is a much harder asset to understand. The value of goodwill is linked to assets and to factors such as customer relationships, length of contracts currently in place, likelihood of customer renewals, and overall market conditions and projections, taking account any other external factors on the business. Therefore, it's quite hard to value goodwill. Another issue to consider is that, in essence, goodwill does not have its base cost in the books of the company. So once we do the valuation, when we pay corporation tax, we have to pay it in respect to the whole increase of the goodwill over the life of the company. Therefore, the good rule of thumb is if you have started the business in the UK, if you want to redomicile or change the business abroad or change its place of effective management, is to do it as fast as you can until the business has increased in value and has gained a significant goodwill. Now, after we notify the revenue of the pending departure from the UK, they have significant length of time, up to 2 years, to challenge it and to raise an inquiry and to start looking into whether everything was done appropriately. Also, it is important when a company is leaving the UK to provide a guarantee that it will pay its tax liabilities. Can the company use its business partner? Yes, it can. It can use pretty much anyone. It can use a related company, a non-related company, a foreign company, or a UK company, and the bank, as long as somebody guarantees that the leaving company pays its taxes when it's no longer UK tax resident. So if we succeed in doing this, the company no longer will be UK tax resident, and whatever it earns after it ceases to be UK resident will no longer be subject to UK tax. Of course, we have to consider domestic taxation in the place where the company is going to be resident then. In that case, we chose Malta because of its beneficial tax rates, but this is an overseas problem and we don't need to consider this. In principle, it is possible for the company that is leaving the UK to avoid corporation tax liability on its departure. This will arise if the company leaves a permanent establishment in the UK and there are assets which are associated with the permanent establishment, and the company continues its trade through the permanent establishment. But this was not the case in our situation because the company wanted a clean break with the UK, not to pay any taxes at all. So it is possible, but it is a lengthy and quite an expensive process. But once the company is no longer UK tax resident, it will be considered UK tax registered in the company's house, but it will be tax resident overseas in another country where it will also have to register for corporation tax. What happens if we want to work the other way? What if we want to move a foreign company in the UK? Contrary to the practice in countries such as Luxembourg, Cyprus, and Malta, the UK does not allow inward corporate redomiciliation. I know there have been talks about allowing inward migration in the UK, but so far in the latest budget, these thoughts have not been voiced. Therefore, the only way that a foreign registered company can become a UK taxpayer is for it to be centrally managed and controlled from the UK by appointing a UK board of directors, by moving all the company documents in the UK, and by registering the company for corporation tax purposes. Why would anyone want to do this? Normally, this would be recommended in a situation when a foreign director and a foreign founder is coming to the UK, and they cannot appoint a foreign board of directors in the place of original company's location. In practice, I've seen this a lot when founders of US startups are moving in the UK. Normally, no matter how successful the startup is, it has limited resources, it has limited ability to retain a proper professional board abroad, and they have no choice but to continue managing and controlling the company from the UK, although the company is still back in the US. Of course, there's a very high risk that the UK tax authorities will force such company to be registered for UK corporation tax. So to preempt the situation, they're taking an active step and letting the revenue know that the company is managed and controlled from the UK, following which it will become a UK tax resident. Yes, of course, it will start paying corporation tax, but if it is a holding company, for example, then it will possibly benefit from a broad participation exemption in respect of foreign dividends, substantial shareholding exemption in respect of capital gains, and absence of withholding tax on dividends. On the one hand, the revenue, the UK revenue, will never say no when a foreign company wants to be its tax resident. But there's I'm trying to think of a proper UK metaphor. There's a difficulty associated with a foreign company becoming a UK tax resident. Recently, I've been dealing with a situation when a Singaporean registered company was going to acquire Dutch trading subsidiaries with the view to minimize withholding tax from the Netherlands to the UK, because withholding tax on dividends payable from the Netherlands to Singapore was much higher. As step one, we appointed a UK board of directors for the Singaporean company, following which the company would be registered for the UK corporation tax purposes. However, in order for such company to pay less amount of withholding tax in the Netherlands and to apply the UK-Dutch double tax treaty, it's not enough just to appoint a UK board of directors. It is necessary to demonstrate that such company is effectively managed and controlled from the UK. And to show this, we have to literally write almost an essay explaining how the decisions are taken from the UK, how there are no managers outside the UK, and how everything is properly done here. And this is quite a long and laborious process. So it is important to understand that it will take time if the company wants to obtain double tax treaty benefits. In order to obtain such benefits, the UK company will have to produce a certificate of residence, which it will deliver to the Dutch or any other tax authorities in order to minimize the withholding tax abroad. The tax residence certificate should be contrasted with the confirmation of residence. A confirmation of residence simply says that the company is registered for corporation tax, but it does not meet the UK residence conditions for the purposes of the double tax treaty. Therefore, anyone thinking of making a foreign company UK tax registered should keep this in mind. because otherwise without the certificate, they will not get access to the treaty benefits. We talked about companies moving on their own volition from the UK abroad and from the overseas to the UK. What can also happen is when a person leaves the UK, and this can have a very profound effect on the company that they're managing. Luda mentioned the way how a person can become non-UK resident. Now imagine if such person was or is a director of a UK business. As soon as such person stops exercising their duties as a director from the UK, the company's residence change. Remember in the beginning, I talked about the situation when we wanted the company's residence to change. In this situation, when a person ceases to become UK tax resident, the revenue may force such company to be considered not UK resident and for it to suffer tax on the deemed disposal of its assets. Such issues would typically arise in a situation when there's a private trading UK company and its only director and shareholder is moving abroad. This is what they should keep in mind. What can be done about it? Well, either the departing director should be regularly coming to the UK and exercising management and control of the company from the UK, which we know may not be realistic, or appoint someone who will do this in respect to the company in the absence. We're often asked whether there's exit tax on people leaving the UK. And there are really two instances when exit tax may be an issue. First of all, is when the person is a director of a company and they become a non-UK resident and whatever I just described happens. Another situation is when the departing person was conducting business as a sole trader. Let's say, for example, someone was an IT consultant trading as the entrepreneur in the UK. They have developed a successful career and they've been acting on their own, not through a company. If they cease to be UK tax resident, if they move abroad, they will be considered to have disposed of their trade, and the consequences are the same as before. They will have to pay capital gains tax on the value of the business, they have to do the valuation, etc., etc. I'm often asked what happens if a shareholder moves to the UK or leaves the UK. And there's an important distinction between a shareholder and a director. Of course, it is possible that the company belongs to the same person, to the shareholder and the director. But under company's law, there are two different, I would say, people in the company. Of course, it is possible to commit a so-called usurpation of power when the shareholder essentially fulfills duty of a director. But this is why shareholder on their own do not affect company's residence. Now, another issue that we often see in practice is the risk of a permanent establishment of a foreign company in the UK. Permanent establishment is defined as a fixed place of business through which business of a company is carried out. Imagine a situation when a foreign company, say for the sake of example, registered and tax resident in Dubai, say it is a company which is providing IT services, and its employee or its director is coming to the UK to live in the UK and to conduct certain activities. What would be the risk of such an arrangement? If a director of a Dubai company is coming to the UK and they are exercising management and control of the foreign company in the UK, there's a risk that such foreign company will become UK tax resident and will pay corporation tax on all of its corporate profits. Now, let's say that by magic, such person does not manage and control the company from the UK. Let's say they're diligent and they always physically leave the UK to control the company, or they have kept another director in Dubai, in our example, who is managing and controlling the company from abroad. In this case, the risk of the company becoming UK tax resident is manageable. But what if the same person starts negotiating with customers in the UK? What if such person starts providing back office functions for the company? On the one hand, it is possible to argue that the company is not fully operational in the UK. There's only part of it being run in the UK, but the activities which I have just described negotiating with customers, and even providing back office functions. This is exactly business of the company. On the one hand, dealing with the customers is the business proper, which leads to taxable revenue. On the other hand, back office functions, although on the surface, they're not business of the company because they're internal, nevertheless, they're still from part of what the company is actually doing. So it is very important to manage these risks. In the first scenario, when we are negotiating with customers, this just simply must not be done in the UK, because otherwise any contracts negotiated with customers in the UK, any transactions entered into thanks to the participation of the foreign person being in the UK, they will be subject to tax in the UK. If such person comes here and starts providing back office functions, of course, the risk of the revenue attributing income to such back office functions is very small, but nevertheless, there's still a risk that they might look into what such person is doing in the UK. To preempt this risk, it is important that there's an agreement, a services agreement between the UK person and the company, under which there's an arm's length remuneration for the actions. Typically, it is easy to understand the quantum of such remuneration. Whatever similar companies are paying in the market for back office functions, this should be stated in the agreement between such person and the company. Of course, it is possible in principle to negotiate contracts on behalf of the company and to enter into business relationships with local customers. But then, of course, the risk for the foreign company to be subject to tax in the UK to profits attributable to the UK permanent establishment are much higher. And it is necessary to demonstrate that the person acting on behalf of a foreign company is an independent agent. Independency is evidenced by factors such as lack of financial dependence on the company, multitude of principles, freedom in choosing the best course of action, etc. But this is generally not recommended. To manage this risk, the foreign company should either act through an independent distributor or just simply by the bullet, register a taxable presence here and conduct business through it. Or simply register a subsidiary in the UK and just know that any risks will be kept within such subsidiary. Any tax liability will be only attributed to the UK functions, and everything else will be kept outside the remit of the UK tax authorities. Because you see, when a foreign tax resident, a registered company, conducts a business in the UK through a permanent establishment, there's always a risk that the UK tax authorities will look not only in the UK part, but at the company overall, and there will be big argument about the quantum of such attribution of profits to the UK permanent establishment or a branch. Therefore, my advice is always to operate through a subsidiary. One last issue that I wanted to cover is quite unexpected. It's UK inheritance tax. To remind you or to tell you, inheritance tax arises if an individual dies owning UK assets. In a typical situation, it would be UK property owned by an individual or also shares in the UK company. It is possible to imagine a situation when someone who has never set foot in the UK owns a business in the UK, and in case of their death, their estate must pay up to 40% inheritance tax by reference of the net asset value of their assets in the UK. Of course, there are certain exemptions, such as, for example, agricultural relief, and there's business property relief, but they all require planning and they all require giving thought to this method of conducting business. It will never be possible to avoid inheritance tax liability in respect of UK real estate. If you have UK property, residential, non-residential, owned through a company in the UK, you pretty much in most cases have to pay inheritance tax on death. But if the company does not own UK real estate, then the easiest way to manage UK inheritance tax liability is to simply put another foreign registered company on top of a UK company. It is impossible to achieve the following. A foreigner is coming in the UK. They're living in the UK. they're running their business in the UK through a UK registered company. Now they can register another company overseas outside the UK, which will be the parent company in respect to the UK subsidiary. They can even register such foreign registered company as a UK taxpayer by exercising UK management and control, making it subject to corporation tax. But because the subsidiary is registered overseas, all of a sudden shields this individual from UK inheritance tax liability in respect of the value of the shares of their UK business. I think I'm coming to the end of my allotted time, and we should take some questions, right, Luda?
Absolutely. Thank you very much. Dim, if you could stop sharing. Yeah.
Thank you both very much. That was really excellent, and I found in particular the use of those kind of hypothetical examples, yeah, it really helped to illustrate the points made. So we do have a couple of questions in thus far. If anybody else does have any questions, we are happy to take a few questions. So please do type in your questions if you have any. First question from Caroline. For personal taxation, what happens if someone is resident in Europe, for example in France, and pays taxes on income earned until the end of December in 1 year, then moves to the UK during the UK tax year and spends more than 183 days? If they have already paid tax in France, can the UK seek to claim tax on their already taxed French source income?
Shall I answer that? Or yes, there is a double agreement, double taxation agreement between two countries, depending on their income, what basis, because sometimes some countries use instead of standard method calculating, they're taking gross, taxation on gross income. So, but generally speaking, there are provisions, double tax provisions between European countries, and the majority of them would sign up for OECD. And yes, so you can claim pretty much in the majority of cases there would be by credit method. You can use credit method and deduct your tax liability in the UK by the foreign tax you've paid in Europe and France. Does it answer the question?
I just wanted to add a few things
sure.
Talking about the double tax relief. Also, the person coming to the UK may be able to claim split year treatment, which means that UK's tax year runs from 6th of April until the 5th of April of the following year. Of course, French tax year runs as a calendar year. So there's a possibility. So the UK tax year from April to 31st of December falls upon the French tax year, which is running from January to December. It is possible, first of all, to split the year and only become resident from 1st of January, which means that income earned in France before the end of the year would simply be outside of a UK tax. This is first point. Second, it is possible to rely on double tax treaty residence provision between France and the UK if the person's central vital interest was at France from January to December and not in the UK from April till December. Such income can be excluded from UK tax. Whereas once the person is UK resident in the UK after January and no longer in France, then under double tax treaty, essentially the first period will be excluded from tax. And of course, as Luda said, it is possible to obtain double tax relief. I just want to say one last thing. If a person is a UK tax resident and they're subject to tax on remittance basis, there's a typically limitation benefits provision in most treaties concluded by the UK. It says that if the person is not subject to tax on their foreign income, which happens under remittance basis, they cannot obtain the treaty relief. So it's just important to be aware of it. So there's limitation benefits provision.
Thank you very much. Another question from AJ. There is no statutory right of redomicile out of the UK, but you are reliant on the relevant tax treaty. That could take years to settle. surely the CH gains arising as well as the length of time involved is going to make this unattractive.
I'm not 100% sure what the commentator means here. Yes, there is no statutory right to redomicile in the sense that the UK registered company will always remain a UK registered company. Whereas if there's a double tax treaty between the UK and the destination country, then under the double tax treaty, it is possible to redomicile for tax purposes abroad. So I think I'm just rephrasing what this person is saying. Whether it could take years to settle, yes and no. But you see, on the one hand, on the one hand, you expect to settle the agreement between the two tax authorities and let them decide where you're tax resident. But on the other hand, the UK tax authorities allow the company to be non-UK resident if there's a double tax treaty. So you don't necessarily have to rely on the agreement between the two tax authorities. So there is no straight answer to the person's question. It's a discussion point rather.
No problem. And another question: when determining dual residence for an individual, how long does the MAP procedure typically take? Mutual assurance procedure.
Well, generally speaking, if I may answer that, according to OECD, they suppose the competent authorities, if competent authorities are unable to reach the agreement, they should resolve the issues within 2 years from the date when all information is available to them. Now, how long would take to collect the information? That's number one, and then how long it would take. And I mean, they typically have 2 years. How many years in practice? I assume 2 years. We haven't gone that route as yet. So I'll be honest with you, but they should reach agreement within a couple of years, if that answers the question. Thank you.
For this reason, it's always best not to rely on MAP, because it's always best to just reach become non-resident under domestic law. And one other issue that we've not mentioned is the principal purpose test. Under multilateral agreements after BEPS, most treaties now have this principal purpose test, that you cannot rely on the double tax treaty benefits if the principal purpose of it is to avoid tax. So this could add an extra uncertainty factor. So it has to show for proper non-tax reasons and for business purposes.
Yeah.
There's an interesting question from Vsevolod. I don't know, Rory, if you want to read it out.
Yes. So just returning to the part on the tax certificates for the entities which shifted the tax residency to the UK. Did we hear it correctly that they cannot obtain a certificate for the purposes of tax treaty?
Yes, you can. It's I mentioned certificate of residence versus confirmation of residence. To obtain double tax, to obtain the tax treaty benefits, you must get the tax residence certificate, and you get this by demonstrating that the company is centrally managed and controlled from the UK. So yes, you can, as long as all the facts point at this direction.
Yeah. Absolutely, yeah. So it's in reality, I mean, in the UK, if you're UK generally corporate, if you're registered in the UK, that's pretty much easy to apply for UK tax residency certificate by applying the HMRC. And actually, the last one we received was within a couple of days, so which was quite quick. Thank you. Right. Any other questions, or I think we are just overrun a bit by 3 minutes, but yeah.
That's okay. Yes, if anyone does have one last question, we can probably squeeze another one in, but otherwise, it's on me to round up. So obviously a huge thank you from myself and colleagues at the CIOT and the ADIT team in particular to Luda and Dmitry for all their insights on this fascinating and and really pertinent topic. We've got follow-up email that we will share with all of the participants. So all of our viewers, both those joining live and those who are hoping to watch it later, we will be sharing the recording. So if there's anything that you've missed or that you'd like to revisit, you'll be able to do that with the recording, and the presentation slides as well will be included there as well. So you'll be able to view those too. Yes, so once again, a huge thank you from the team to you both, and we hope that all of our viewers have enjoyed the webinar and found it worthwhile and useful.
Thank you very much, Rory. Thank you, Vicky, Rory. Thank you for organizing. Thank you all participants for your time. Such an honor. Thank you very much indeed from us with Dmitry. Thank you.
I will just thank you.
Thank you both. All the best, and take care, everybody. Enjoy the rest.
Thank you very much, guys. Bye.
Bye.